Well, good morning there, ladies and gents. Good afternoon, or good evening, depending on where you're from. This is Kurt Frankenberg. I'm the founder of RadioActive Trading and author of The Blueprint, and I'm joined today by the Director of Options Education over at Power Options, Mr. Mike Chuck. Good morning, Mike.
Good morning, Kurt. How are we doing today, sir?
I'm doing well. I'm doing so well I can barely stand it.
That's great.
All right. Hey, listen, today we wanted to go through, and this is with permission, of course, and first names only, but I'd like to go through some recent radioactive traders that have bulletproofed their positions, and these particular radioactive traders actually did so before picking up the blueprint. And using the information that's available on these webinars, actually one of them hired me to do what should I call it?
Coaching.
Coaching,
mentoring.
yeah, exactly. I took a look at the positions that he was in. One of our fellows was in a place where he already had stock and wanted to make it bulletproof and not have to pay for insurance, right? And the other gentleman plays very volatile, high-flying stocks. When I say high-flying, what I mean is that they can go up like a rocket, but they can also crash. And biotechs in particular. And I was very impressed with his attitude of picking stocks. It was not about being a winner every time. It was about, geez, if I do lose on this, I'm going to lose only a very small amount. But I only need just 6 or 7 of these a year, and it does very well. And this gentleman had mentioned to me here very recently that he's got about 25% winners. Well, that doesn't sound like a very good track record, does it, Mike?
No, I mean, if I went to an advisory newsletter service and they are touting that, hey, we're only right 25% of the time, I might be a little bit concerned. But when you delve deeper into it and say, oh, when you lose, I see you're only losing 5 or 6%, but when you win, you're, winning maybe 25, 24% gains. Now that's a little bit different, isn't it?
It is different, yeah. It doesn't matter how often you're right. It just matters how right you are. So anyway, I thought I would share, without divulging any private information, just share the gist of those trades. And before we got into it, Mike, I thought I would show some slides that we've been showing for a very long period of time. Some of our little vignettes where depending on the audience's needs and where they're at, we would show these little brief mini presentations, okay? And all of it, of course, is to serve the need of teaching folks how to limit risk. And after taking care of that, after taking care of limiting risk, being able to have an unlimited upside, okay? All right, let me find out right now what the composition of our audience is today. We got several dozen attendees from all over the globe, and I'd like to see just what stage you are in your relationship with radioactive trading. Mike, so far it looks like we've got a pretty strong showing for folks that already own the blueprint.
Okay.
Very good. Okay, Mike, I'm gonna encourage everybody to participate in these polls because some of the polls are instructive in nature. Some of them are going to guide Mike and I, and some of them are also going to help you to learn a particular point of trading, and it's all geared to serving whoever's on the line. Okay, so Mike, I'm going to go ahead and close and share the results. We've got 55% are using the free materials and 45% are thinking about buying the blueprint. 35% of our attendees already own the blueprint, and that may have been within the last few months, or it may we may have some veteran owners. I guess we'll probably see when we run another poll, won't we?
Yes.
And 10% have done some or all of the Mastery Series CDs, which we just came out with a new one. And it was kind of a foundational thing for teaching how all the income methods, how we came up with them and how we apply them.
And it
And
really,
what do we call that, Mike? I've forgotten.
it was income methods beginnings, but we really focused on the nuts and bolts of income method numbers 1 and number 2, and showed some
Right.
recent examples where there were positions that were bulletproofed using income method number 1, and where they could be bulletproof by applying income method number 2.
Right, right. And we also showed how to manage income method 5, didn't we?
Mm-hmm.
Using either 1 or 2, so it may seem a little confusing, the jargon and everything. I do list the term that the option is actually called by. When we say income method number 1, of course, we're referring to a covered call. And income method number 5 is a ratio call spread done within the context of a married put to capture more upside. So anyway, Mike, we are on. Can we? Did we hide the results?
You did now, sir.
Oh, okay, very good. Okay, I wanted to see just before we started what kinds of options trading everybody's doing now, because I think the slides that I have up are appropriate. But before I dive into it, I just want to make sure what our audience is experienced with, what they may not be experienced with, and so on. Guys, thanks for this participation. I'm seeing those results just pour in, and it is appreciated. Again, this helps Mike and I, but it's also going to help you, because we like to tailor each one of these presentations and meet the needs of the folks that are on the line. Okay? All right. Mike, I'm going to go ahead and give it 3, 2, 1. Get your vote in if you haven't, and boom. Okay. We've got just a small number of folks that don't like options, and I'm going to say that if you don't like options, there's only really 1 or 2 reasons. Okay, one reason is that you just don't understand them. It's like, well, I'd trade that, but I don't get it, and that's fine. The second reason why somebody would not like options is perhaps they were taught just enough to get into trouble. And that's what happened with me, Mike. About 11 years ago, I lost my entire life savings playing options, not understanding the positions that I was in, not understanding the risk. And both of those problems are solved by education, and we give a lot of it away free here. Some of the real nuts and bolts and nitty-gritty we do charge for. But a very large amount of options education that we do here is free and will bring you up to speed to where you'll understand all the jargon, all the things that go with it, and you'll also understand what options were really designed for. Mike, they were designed as a hedge, not as a leverage tool. Isn't that right?
That's exactly right. Yeah, designed as a hedge, used to be able to have different ways to trade different positions where you're not risking as much potentially.
That's right. Okay, and we're going to be sharing a comparison of hedge strategies here in just a minute. Okay, now Mike, we've got 65% doing covered calls. That's a pretty long, a pretty large contingent there. 69% doing long calls and puts, and 62% doing spread trades. So we've got a pretty sophisticated audience. But I'd like to do something that that even sophisticated students of options don't always get. Okay, so I'm going to go ahead and hide that. Mike, do you see comparing hedge strategies?
Yes, sir.
Very good. Okay, now this is not aimed as a criticism of covered calls, okay? Essentially what it is it's an eye-opener to show you that there's more than one way to peel an apple, all right? And some of them in particular markets are going to be preferred to others. Covered calls can be good in a very particular market. And the very particular market that I'm talking about, Mike, is a sideways moving volatile market.
Okay.
If it's moving sideways, we're going to not sort winners out of our account, right? And we're not going to suffer the pain of owning a stock because, after all, a covered call is simply a hedge on a long stock position, right? You own the stock, but then you also short a call against it, okay? But a lot of folks are leaving it. And Mike, here's why. Okay, more and more folks are starting to ask very cogent questions about this. But let's step away from the stock market for just a minute, and let's just say, if I was to come to you, Mike, if I was to say, look, I've got 2 choices of some investments. I've been looking at some investments, Mike, and I trust you and I value your opinion. One of them has a limited profit potential. I mean, once it's done, it's done. Okay?
Okay.
But I also have a risk. In fact, my risk is, well, I could lose everything. On the other hand, I've got this other investment that I'm looking at that there's no telling how high it could go. But the really good part about it is that I'm able to keep my risk down into single digits. Just in case I'm wrong, out of $100 that I invest, I'm going to have $95 back. But it's really unlimited how high it could go. Which of these two do you think would be a smarter play for me?
Well, I would suggest that you go with method number 2. You want to see something that has the potential for a high gain, potentially high gain, but if you're wrong, well, you're not going to risk too much of what you already invested.
That's right. Now, what I've just done is I've just described two different hedges on a long stock position. If you own long stock and you want to hedge it with a covered call trade, Mike, you're going to take in a little bit of income.
Sure.
But you're also going to cap your upside.
Mm-hmm.
On the other hand, shorting a call is a near-term bearish play, right?
That's right. Yeah, we're going to expect that the stock stays around the same price or doesn't rocket above the strike price of the call that we sold.
Right. On the other hand, if we buy a put, is that also a bearish play?
By itself, absolutely. If I just buy a put, I'm expecting the stock to drop in price. I'm speculating in a directional movement to get a leveraged increase on my option.
Yeah. You know what? If a lot of folks, if they think that a stock is going to go down, they just totally load up on puts. And if they're right, that's going to make for an outsized return.
Mm-hmm.
Okay. But on the other hand, if they're wrong, it's that leverage is going to be used against them, and that's not the way to go. At least I don't think so. The way that option contracts were designed and what they're designed for is to be a hedge, okay, just in case we're wrong. Okay, so this represents the hedge here, Mike. We've got our stock ownership, but we've also got, just in case we're wrong, we've got a floor to what our losses could be.
Mm-hmm.
Right? Now, Mike, the reason that I believe that so many people, even though they're maybe aware of these strategies, I think the reason that so many really smart people get into selling covered calls is that the idea of taking income from a stock that you already own is really attractive. Now, a little bit later in this presentation, I'm going to show how one of my pupils here recently was able to bulletproof a stock, but also take income and also have his upside unlimited.
Mm-hmm.
Does that sound pretty attractive to you?
Absolutely, yeah. I mean, I have a place right now where I've got, what do I have? I have 3 positions like that right now. Well, two positions like that right now.
You got 2 bulletproof positions and one that's pretty darn near.
Yeah, but it is capped. That silver wheaton position we discussed on Saturday and I showed again on Tuesday, it is essentially bulletproof, but I do have a capped gain because I used income method number 1.
Right. Is that a near-term call? Is it going to expire?
In August. I'm hoping it's going to expire. It's a 21 call, and it's for August, and I think silver wheaton right now is around $19. So I'm looking for that to expire worthless, and then the position will be bulletproof, and I can continue to move forward.
Yay, we love when we're bulletproof and we don't have a cap on our upside.
Mm-hmm.
Well, anyway, Mike, the idea of buying insurance for your stock is not as attractive. In fact, the biggest objection that I hear from everyone is, well, geez, you limit how much you could make. You know, you cut into your profits. And that's not really so. In fact, honestly, Mike, I've seen folks be able to completely pay for their put options by using income methods. I've done that as well.
Mm-hmm.
And I've actually even had some cases, where my stock goes up, say 8, 9%, but my position goes up 12.9%.
Mm-hmm.
Okay, and it's because of the income methods, and it's done within the context of still having insurance. Okay, so I'm going to say that buying insurance, it may not seem sexy, okay, but you know what? It's absolutely vital to learn to keep a cap on your losses, but not a cap on your upside. Okay?
Right.
Now we're going to do a comparison here, Mike, in this very presentation, okay, about December of last year, or November of last year. We had a lady come in that said, well, you know, I recently did pretty well with a covered call trade with C-Trip. Can you tell me if your system would have worked better?
Mm-hmm.
And I said, well, let's take a look at it. Give me your numbers, okay? So here's what she did. She picked up C-Trip, okay, when it was trading at 57.88. Now, Mike, she didn't buy it at 57.88. She did a covered write, which means essentially that she did a covered call at the same moment that she bought the stock,
Mm-hmm.
okay? So she sold the November $60 call options for $2.30, and C-Trip at that time was trading at 57.88. So her total cost basis here is 55.58, right?
Mm-hmm. Yes.
Okay. Now, if that stock goes down, how protected is she?
Well, she's really just protected the $2.30, isn't she, Kurt?
Yeah, the $2.30 is the extent of her hedge. If that stock goes down to $40, she loses 15.58, right?
That's right.
And that may sound ridiculous. You might be saying, well, Kurt, it's not going to go down by $15. Well, I beg to differ, because guess what? The stock went up by $15.
Mm-hmm.
You know, she was playing a volatile stock, and if it can go up by 15 in the matter of a few days, can it also go down by 15 in a matter of a few days?
It absolutely could. That's right.
Right. So this really isn't much of a hedge as far as protection is concerned, but let's see how profitable it was, okay? She did do pretty well. With a buy price of $55.58 and the obligation to sell at $60, because it was the $60 calls, here's what happened. She was called out of her winning stock, okay, and needed to deliver them at $60 a share. Now, the argument is, well, she could have rolled those calls. Well, how are you going to roll the calls when the stock is up above 70? You're going to buy it back for more than you received, right?
Yeah, it's going to be very tough, isn't it, Kurt?
Okay, but you know, long story short, she made a really nice profit. Okay, it's $4.42 per share, and if you divide the 442 by the 55.58 that she invested, that is a decent return. Okay, 442 per share profit is good. 1336 profit is good. All right, 7.9% profit in 16 days is good. Okay, and I don't like to give this annualized return example, but a lot of the covered call trading gurus do, so I'll put it up there. I don't like that example. Why? Why is that why don't I think that's very honest, Mike?
Well, it's making a very large assumption. I mean, you had success on this trade, great. You made 7.9% in 16 days, but are you going to be able to do that every 16 days? That's a lower probability that that's likely to happen.
Yeah, that's a big assumption. All right. But honestly, that was a good return. But the question was, well, would your married put have done better? You know, where you're paying for insurance, and rather than shorting a call and taking income, how could you possibly do better if you're paying more money for a long put? And I said, well, okay, let's look at the blueprint, and let's look at the historical data from that date, and let's pick the put option that the blueprint would say we should get into. Okay, so if we're bullish, you do a cover call trade if you're bullish, right, Mike?
Yes, if I'm neutral to bullish, that's a strategy that is applied. Absolutely.
Okay, but if you're bullish on the stock and it costs $57.88, I'm not going to be taking a credit, Mike, by selling a call. I'm going to be paying out $13.70.
Mm-hmm.
Okay, now that doesn't look very attractive. But what I'm doing here, Mike, is I'm doing it according to the blueprint. I'm buying, it's November, I'm buying 6-7 months out and deep in the money. I'm buying these puts according to the dictates of the blueprint, okay? And what I end up here is a total cost basis of $71.58. Now, is my investment greater?
Yes, we have more outlay into the position. You have more capital into the position.
Okay. Now, another thing that I should mention is instead of a cost basis of $55.58, I've got a cost basis of $71.58. But, Mike, I've got a guaranteed exit. And that guaranteed exit is because of that put option. No matter what happens to C-Trip, if it goes down $15 a share, like we have mentioned is very possible, I'm going to still be able to sell it for $65 a share.
Yes.
Okay, I'm going to have that privilege, that right that I can enforce. Okay, and so really, out of this $13.70 that I'm spending, I'm guaranteed to get most of it back, aren't I?
That's right.
Yeah, looky. 658 is the difference between my cost and my definite guaranteed exit, okay?
Mm-hmm.
And if we divide the 658 by the 7158, we come up with, I've only got less than 10%. I've only got about 9% of my capital at risk. Pretty cool so far?
I'm with you so far.
Okay. Now I should mention that C-Trip pays a dividend, and if I decide to hold this whole 7 months, I'm going to collect that dividend.
Mm-hmm.
Also, there is a pricing disparity between doing it this way and buying a call option. If I buy a call option, like it seems as though most of our players here today know how to do, okay? But if I'm buying a call option, number one, I don't always know how many call options I should get, right?
Mm-hmm. That's
So
true.
with the married put strategy, it's already locked in. I kind of figure out the money management for myself. I'm prevented, Mike, from risking or leveraging too much.
Mm-hmm.
Number two, I can actually get a better price. The at-risk amount is $658, but if I'd have bought a call option, it would have cost more.
Right.
Okay. So here's my at-risk amount. Long story short, let's see what happens. Okay. When the stock goes up after earnings, okay, we're just going to look at what it does after 9 days. After 9 days, the earnings announcement made it shoot up. And then by expiration of the call
Mm-hmm.
from our other person's play, it went up even higher. So I'm going to just use the really conservative amounts, okay? I'm going to go with the really conservative amounts, and I'm going to say, hey, look, who knew that a better hedge, it's a better hedge in the first place, right?
Yes.
Would also make for a better return. You see, when C-Trip went up above 70, the puts did not go to zero. Okay, the puts did go down in value, yes, but they didn't go to zero. And we were able to take those put options and sell them and also sell the stock, and then our total back into the account would be $79.89. Now, $79.89 minus the $71.58 that we got into it, that's a per share profit of $8.31. Mike, is that better than $4.42?
Absolutely. It's almost twice as much, right?
Yeah. A dollar amount, it's nearly twice as much, okay? And as far as a percent, yes, I did invest more in the married put than in the short, the covered call. But even on that larger amount invested, there was a larger percent return.
Mm-hmm.
Pretty cool.
Yeah, absolutely.
Okay. And that's the kind of setup that I'm trying to help folks understand is that, geez, you know, if you set yourself up so that you can't possibly lose too much, that's the beginning point.
Mm-hmm.
After that, Mike, it's unlimited. Okay, you have an unlimited upside potential. Now, Mike, that was just if we closed the position at the same time that our friend was obligated to close hers.
Mm-hmm.
But could we do some other things beyond what we've shown?
Oh, of course. I mean, there's 10 different income methods that could have been applied to this technique while still having the married put in place after the move. And, you know, you could have generated more income. You could have potentially bulletproofed the position and kept trading it as well.
Right. Before we get into the income methods, Mike, because we really haven't shown any income methods yet, I'd like to run a poll of our existing, you know, everybody that's online, and ask, hey, you know, how happy are you with your trading so far for the last 12 months? How happy are you with your trading? And then we're going to share income strategies for buy and holders. Now, Mike, I've got two different ones. One would be how to bulletproof using income method number 4, right? And I'll share an antiquated example, an example that I did like years ago. Although I've done some other examples recently. But then I'd also like to show an example of what was done here just very recently by one of our clients. In fact, he was pretty much bulletproof as of August 1st. Shall we show that first, income method number 4, or shall we show the bulletproofing and then taking income?
Maybe go with the bulletproofing and then taking income. But It's your choice.
Okay, very good. We're going to share them both here in just a minute. And Mike, I'm very pleased because we're having a much higher percentage of people saying, yes, I'm happy with my trading results than we normally do. Let me go ahead and close the results. I'm sorry, close the poll and share the results. Mike, that's a lot bigger number than we normally see, isn't it?
Yeah, and that's great.
Yeah, although it's not as big as I'd like for it to be.
Mm-hmm.
Sometimes Mike and I have actually seen 0 in that column of yes. We've seen single digits a lot lately, and usually it's kind of averages out to where it's about 20%. About 20% say yes, and about 80% say either no or mixed emotions.
Mm-hmm.
And today we've got a higher number than usual. Now, I'm not going to try and take credit for that, Mike, but I am going to mention that we do have a large number of folks that have invested in the blueprint, okay? 35% own the blueprint. And I don't know how many of you only just recently purchased it or purchased it 12 months or more ago, all right? But certainly, Mike, we do have a bigger number of folks saying yes than normal, and that's good. Now, for the other 72%, listen, the 28% that said, yes, I'm happy with my trading results, let me congratulate you. I'm very excited because you've beaten the market, okay? And almost everyone that plays the stock market loses at it. You haven't been playing it. You've been working it. You've been treating it like a business and exceeding the expectations, okay? Now, I'm going to mention to everyone that probably one of the reasons that these folks are in the yes category is because they do things like what we're doing today.
Mm-hmm.
So we're all in good company, aren't we?
Yes, we are.
Right. We're doing something about it. The 38% that said no, I'm going to congratulate you because you recognize that there's a problem and you're here to solve it, all right? And the 34% that said mixed emotions, I'm going to say that that was me, okay? I had mixed emotions too. Mike, you know, from my history, about 11 years ago, I was making money doing covered calls, and then I lost everything because I didn't understand risk.
Mm-hmm.
So I had mixed emotions, didn't I?
Yes, you did. You saw some valuable returns, you saw some value, but then it was wiped out from you.
Right. I also got hurt, okay? So I'm going to say that we've got 28% saying yes and 72% saying essentially no. So I'm going to ask this question. I want you to take a very careful look at all 5 of these answers, all 5, and decide which one of those 5 you would take if you could only have that one. What do you think you need? What single thing do you think you need to be more successful at trading? Mike, so far we've got 100% in the category that I expected we'd have a winner. Okay, now we're starting to get 3 different categories. We're still in just 3 different categories. Oh, 4 categories now. Now we can't all be right, can we?
No, we can't.
I mean, honestly, Mike, if I ask you what 7 times 8 is and you tell me 56, and I say, well, no, I think it ought to be 63 this week, is that going to make me right?
No, not at all.
Probably not. Okay. All right. But for each of these folks on the line, well, guess what? It might be right for them because maybe they've got the other categories handled, right?
Mm-hmm.
Okay. But still, I think that our winner is what most folks need. And I thought that it would be this. Okay, what's the clear winner, Mike?
The clear winner is limit losses more, sir.
That's right. And some folks want to make their wins bigger. I'm going to tell you that you can do that. But on your way to bigger wins, let's make sure we don't lose. You know, for example, Mike, if you have 100% gain, that would be a good thing to talk about, right?
Mm-hmm.
What if right before that 100% gain you had a 50% loss, just a 50% loss? Would you still have something to brag about?
Well, I mean, not really.
Yeah, because you'd be in the same place you started.
That's right.
See, losing 50% means half of your account is gone. And making 100% means you double your money. So if you lose half your account and then double your money, you're back where you started, minus commissions.
Mm-hmm.
Okay, so there's nothing to brag about. All right, so keeping your wins bigger is not really the biggest thing to do. Now, Mike, if you lose 50% and you need to make 100% to get back to even, what if you lose 5%? What do you need to get back to even?
Well, if I divide by, if I lose 5%, and we follow that same rule, that if I lost 50 and I need to make 100, if I divide both by 10, I might think that I might need 10% to get back to break even, but that's not true, is it?
No. If you lose 5%, Mike, to get back to even, all you got to do is make 5.26%. You see, if you keep your losses low, you can have modest wins and still do very, very well. Mike, if you lose nickels and make dimes, you could actually be wrong more often than right and still make money. Okay? All right, now 11% think they need to spend more time with stock selection. I don't know. If you're going to spend more time with stock selection, why would you do that? Would it maybe be to limit your losses more or make your wins bigger? I think so. If you had a more reliable system for timing your trades, what do you think that would serve, Mike? Maybe limit your losses more?
Maybe. Yeah.
Making your wins bigger. Okay. All right. So remember, the question was pick one. I'll take door number 4, Mike. I'm going to limit my losses more, because if I keep my losses low, I don't even have to have really big wins in order to make money. Right? All right. Now, Mike, let's go ahead and talk about just before that. Let's run one more poll, okay? And the reason that we're running this poll is, and this whole presentation isn't going to be about polls, guys. All right. But again, these polls are instructive. We're teaching by way of the polls, by way of asking questions. This is the Socratic method. Socrates used to ask questions of his pupils and let them come to their own conclusions, because he believed that wisdom was within, and that he was going to be able to draw that out. Okay. If you could keep your wins from last year and your losses were pared down to 6% instead of whatever they were, would that have changed your answer? And now, Mike, the answer to this question is very important. But more important than the answer to this question is, what will we answer a year from today? A year from today, are we going to use the insight between now and 12 months from now? Are we going to use the insight that we just received and actually apply it to our trading? Or are we going to be lured by the prospect of huge gains and take bigger risks than we should? Okay? Mike, let me share the results of that poll. Okay? Out of everybody that participated, 81% said that they would have been happy with their trading results. Is 81% better than 28?
Yes, it is. It's 3 times as much.
Okay. Yeah. With the 19% would have said no, but been closer to yes. I'm going to venture to say that they might be further ahead than where they are, right? Yeah, because they say they'd be closer to yes, okay? And nobody that answered anyway, nobody would have still said no or mixed emotions. And if you didn't vote, it's your fault. But listen, we've got 81% would have been happy with their trading results last year had they only applied this one thing. Let's show how to apply that, Mike. Okay. Shall we? All right. I'm gonna not show this particular webinar that this particular slides that I was going to do. I want to get into whoops, where am I here? I want to show the how-to, okay? And it's really important to me to make sure that we answer the needs of the people that are on the line, okay, Mike? So let's just blaze through this real quick, because it's important to me to give away this system, okay? Mike, here's how to keep our losses, our possible losses, down to a very small amount.
Okay.
And what we've got here, this is what I call a radioactive profit machine. It's a setup where we buy shares of stock, but then we also go in the money and out in time with our put option. Out of the total invested, we're guaranteed to get most of it back, okay? And this number, 590, divided by this number, 7090, is the amount that we have at risk. So we only have nickels at risk, right?
That's right. We're only risking nickels on the position.
Right, and if the stock goes up, then we make dimes, okay? And that's really the the deal, because the problem is that we just don't know the future.
Mm-hmm.
Do we, Mike? I mean, we don't know what's going to happen next. If I knew what was going to happen next, certainly I would be able to play this chart and make piles of money. But I know that a lot of folks that were in XL Maritime carriers at the time that I was got hurt.
Mm-hmm.
Either by shorting
Right.
and seeing it go up violently, okay, or by going long and seeing it go down and maybe getting out there and then seeing it go back up again, but just without it.
Mm-hmm.
That wasn't fun. But Mike, when I played XL Maritime carriers in this time frame here, I never had more than single digits at risk. 3 weeks in, I was bulletproof, which means that there was no longer any risk. And then 3 weeks later, took out 10.22%.
Mm-hmm.
Again, it's about risking nickels and making dimes. Okay. I'm just blazing through because I wanted to show what's possible. Okay, Mike. What's possible is using your put option as a virtual stop, and the stop is not a stop order that. Mike, have you been hurt by a stop order before?
Oh, yeah. I've used stop orders before, following some rules by popular pundits and popular gurus, putting a 7 to 8% stop loss on a position, hit earnings, drop down 33, 34%, and I got stopped out for a loss of 33, 34%.
Right. You didn't get stopped out at your 7 or 8% protection level. You got stopped out with a, with a overnight Zimmer. Okay, I don't know what to even call it. But okay, here we've got 4.4% at risk. And Mike, is that going to be finicky? Is that something that is going to be here today, gone tomorrow? It's not really what I'm locked in at. I'm likely to risk more than that.
No, you are absolutely guaranteed to only risk 4.4%. The most you could lose on the position if everything goes wrong, even if it drops down to a penny per share, would be 4.4%.
Right. Okay. And then after that, we can use the income methods and use the income methods to adjust our position. Okay. So, Mike, I'm going to go ahead and show income method number 4. Okay. The difference when we trade RadioActive is we begin at a place where our risk is limited. All right. But then after that, that's a platform from which to launch other trades that normally would carry risk, like a spread trade.
Mm-hmm.
But they don't. They don't carry risk. Okay. Because it's done in the context of the RadioActive profit machine. There's 9 ways to take money out without adding to any risk. And I'm going to share income method 4, first of all. And Mike, here in a minute, maybe we can show your tools, and we can talk about Bill's trades that he did here recently. Okay? All right, are you ready?
Yes, go ahead.
Okay, this is DIA, and I like to use this example because it's one of my favorite examples that's simple. I've used a lot of income method number 4 trades on stocks, but this particular one is just one of my most clear and straightforward examples. And it's also posted on one of my, a fellow that used to be a critic of mine. It's posted on his website. I put it on there real time when I enter the position. And now that critic is kind of a partner. DIA shares at 115. I also picked up the 4 months out, the $119 put option for $5.
Mm-hmm.
So Mike, my total invested amount is 120, and I'm insured at 119. So what's my at-risk amount?
Well, it's only $1, Kurt.
Okay, now coincidentally, not coincidentally, but as a matter of course, this amount, this dollar amount here that's at risk is equal to the time value portion of that put option's pricing. Okay, for example, this put is how far in the money. If it's a $119 put and the stock is trading at 115, how in the money is that put?
Well, it's 4 points in the money, Kurt.
4 points in the money, so $1 is the time value, right?
Mm-hmm. That's right.
Okay, now at this time, the call options were trading for $2.05, but the put option plus the stock only risks $1. Okay, so there's a bit of a disparity there in the put and call pricing. Okay, Now here's what happened. The stock went from $115 to $120. Now that's not a very big move, is it?
No, not at all. So it's a less than a 5% move. That's pretty reasonable.
Right. Now, when the stock is at 120, how much of the $119 put option is time value?
Well, now that the stock's moved up to 120, it's out of the money, so all of it is time premium.
All of it is time premium. Okay. Now, Mike, here's a very interesting phenomenon. That put option had been priced at $5. Now it's $2.05. So did I lose on the put?
Yes, you lost on the put. We can't deny that. You originally paid $5 for it. It's now at $2.05, so you have a loss of $2.95, don't you?
Right. But in order to realize that loss of $2.95, the stock had to go up by $5. So I'm doing okay. And here's the other part of it. Mike, the time value portion of that put options pricing had been $1. Now it's $2.05. So the time value has more than doubled. That's an interesting phenomenon that happens, and we document that in the blueprint. It happens with every stock, with every option, both call and put option. As it approaches being at the money, the time value swells. Now, here's what we did. We took advantage of that bell curve, the ATM bell curve is what I call it, to swap puts. Did income method number 4 and added a year to the play and also bulletproof the stock. And here's how it goes, okay? Mike, I bought to open a January 08 $128 put for $970 and sold to close the January 07 $119 put for $205. So now my total invested amount is $765. Now wait a minute. It looks like I put more money into the trade, doesn't it?
That's right. You did. You put $765 in there and added to our cost basis, didn't we?
That's right. Now this is the only one that does this. Income method number 4 is the only one of the adjustments, of the 10 adjustments, that actually is done at a debit. But let's look at the effect of it, okay? By the way, this is one commission, okay? When you close one put and open another, you do it in, for example, Options Express account. This cost me $9.95 in commissions, $9.95, okay? Now, here's our original setup. DIA shares at 115, $5 for the put. I've paid 120 in, right?
Yes.
I do this spread trade with a single commission, and it gives me a cost basis of $765 more. All right. So far I've invested $127.65, right? All right, and this is my put option. It's a $128 put now. So how much do I have at risk?
Well, you've got a cost basis now of $127.65, but you've got a $128 guaranteed exit, so you're guaranteed 35 cents of profit. You have a negative maximum risk or guaranteed profit of 35 cents, and you still have an unlimited upside profit potential.
Right. I'm unlimited. I can't possibly lose, and yet at the same time we've got no way. There's no way to lose, but at the same time we've got unlimited prospects, okay? Now, Mike, in the red dot here, this is everything I've described so far: buying the stock, buying the put, rolling the put, okay, and making it bulletproof. Now, the rest of the chart represents the term of that $128 put, okay? It goes clear out to January 2008, and I did this in 2006. So, Mike, I've got 15 months. Did I forget to mention that DIA pays a dividend?
How about that? And at this point, it was a monthly dividend, wasn't it?
Right. Okay, so I'm still taking in income. At the same time, the stock is rising. And Mike, can you also see and hear some really good opportunities to play income method number 6?
The money nets, maybe even income method number 5.
5 as well, that's right. Okay, we could use the money nets and pull in piles of premium without any kind of risk. Mike, would you believe me a couple of years ago if I told you you could do a bear call spread with 0 risk?
Well, it's kind of a hard thing to do, I would imagine.
Right. But we're going to show that next, okay? So just before I do that, Mike, oh, and by the way, here's my catchy sayings. I like to say, don't pick stocks, pick stops. That's how we begin a radioactive trade, okay? And then I also like to say, don't time trades, trade time. Mike, you've seen where I've gotten in it with the lousiest timing ever. You've gotten into stocks with lousy timing, haven't you?
Yes, I have.
But because you did it correctly, because you played it with the put option and you knew the income method adjustments, you're able to take a losing stock and turn it into a winner.
Mm-hmm. Yes, I have.
Okay, Mike, let's ask what dollar amount we would have done better. Remember that poll that we did earlier?
Mm-hmm.
Asking what kind of difference it would make if you kept your losses last year down to 6%. And I'm pulling up this, and Mike, I'm going to want you in a moment, I'm going to want you to share the tools of power options, and we'll give a couple of recent trades so that we know these aren't just hypotheticals, and it's not just what I can do, it's not just what you can do, it's what our students have done as well. Okay, I'll give this poll about another 5 seconds. 3, 2, 1. If you haven't got your vote in, please do it now. And bingo. Okay. Now, Mike, 5% didn't get it. Okay, they didn't see that forcing yourself to not lose too much would be a good thing. Okay, but everybody else did. 5% would have saved at least $300 on your worst trade last year. 24% would be ahead by $1,000 to almost $5,000. The lion's share, if you had kept your losses down to 6% and also kept your wins, the lion's share would have saved or made $5,000 or more. Wow. And 10% recognize the fact that, hey, you know, when you're wrong, you could have minimal losses, right, and yet buy at the bottom because you haven't lost too much. You know, Mike, if you're playing with 100 marbles and you lose 6 of them, and then you've got 94, you've got a lot of chances to make that up, don't you?
That's right.
Okay. Let me go ahead and hide those results. And, Mike, we're going to go ahead and talk about, this is one of my coaching clients from a few months ago, and then we're going to show some trades from another client here that he just did his last trade yesterday. Okay. Now, this was a personal coaching client that wrote to me. He was holding shares of McDonald's with a low cost basis. Okay, and he'd like to do these 3 things. You ready for this, Mike? McDonald's pays a dividend, but he'd like to have more than just the dividend income. He'd like to turbocharge it. He'd also like to leave the upside completely open, okay? And he'd like to make the position bulletproof. So, can it be done? The most popular way to take income is to sell a covered call, right?
That's right.
Mike, is that going to meet the other 2 criteria?
Well, no. It's going to generate some income, isn't it, Kurt? But we're not going to be able to limit our risk, are we? And we're not going to have unlimited upside profit potential.
Right. It does take income, but it doesn't limit risk, and it doesn't give you unlimited upside. Okay? All right. Now, a put option would give you unlimited upside, but, Mike, does it give us any income?
No. We paid a little bit more, or we paid a little bit extra into this position. But, you know, we still probably have good return, an unlimited upside profit return, I should say, I'm sorry, but we did add some premium into the position. Okay.
Now, Mike, I'm going to mention that there's at least one covered call trading guru. This is how he's made his living, is by selling covered call seminars. And as recently as about 3 years ago, he was railing against the use of puts. He said, oh, man, you should never use a put. And then he changed his tune. And he began teaching, hey, you know, maybe you should do it. It's kind of a super way to go. And so his super put strategy kind of copies what I was doing about 9 years ago. Would you like to see what that graph looks like?
Sure.
About 9 years ago, I started protecting my stocks with put options and also selling calls. And there's nothing wrong with that, except what's wrong with it? What's wrong with it is you can actually set yourself up to lose one of 2 ways. Now, Mike, if you're right, okay, and your stock closes in this little corridor here, you're going to be doing well, Okay? In fact, if your stock closes less than that short call, why then it'll expire worthless, and you can do it again and again. Okay, and so that's a good thing. But you do have to be really good at picking where the stock is going to land. Okay, so have we figured out unlimited upside yet? Does this one have unlimited upside?
Nope. We've got a capped gain.
Okay, good. So let's, good that you get that, good that everybody's got that. All right, we're going to take one more shot at this, okay? Mike, this gentleman had shares of McDonald's, okay, at $22.15 cost basis. Now, at the time, the stock had gone up quite a bit, and the January $50 put options were 87 cents. Now, to finance the purchase of that, we did a bear call spread here with zero risk. The bear call spread generates 242 on the long side and costs 126 on the this is the short side, and costs 126 on the long side. Okay, so this is a bear call spread with a $1.16 credit. Does the $1.16 pay for the insurance policy?
That's right, it does. Our insurance policy was only 87 cents.
Right, and it expires out in January, although these guys expired in June. Okay, so let's take a look at what this graph looks like, Mike. Boom. What does that look a whole lot like?
It looks almost like a long stock position with a little hiccup in the middle, doesn't it?
Yeah, it looks just like a long stock position, except for guess what? There's something missing.
Well, there's no break-even line, is there, Kurt? We never have a risk of losing anything, even if the stock drops down to maybe, let's say, $25, $28 per share.
Yes, so this personal coaching client was able to take stock that he already owned and make it bulletproof and take income and have an unlimited upside. Okay, and once those calls expired in June, Mike, could he do it again? Could he do another bear call spread?
Absolutely.
Yeah, no reason not to. Okay, so we're bulletproof and no cap and no and turbocharged income. This put option locks McDonald's in all the way up to January 2011. Even if there's some kind of black swan event in the market and the market crashes, he's going to have full value. Okay, and that put costs less than the bear call spread generated the first time out. And then, of course, Mike, it's a January put, but it's a June bear call spread, so he can do it again and again. Pretty cool?
Pretty cool.
Pretty cool, and all the while also collecting dividends, okay? So, Mike, I'm going to turn it over to you next, and just go ahead.
Okay. I'm sorry, Kurt. I was just going to say we have about 5 minutes left, so I wasn't sure what you wanted to do there.
Oh my goodness, my time it got away from me. I apologize there, Mike. I thought we actually had more time. I've got to fix this watch. Okay, all right. Let's let me go ahead and send this out. Okay. What two things so far impress you about this presentation? And Mike, I do still think that we can fulfill our promise, and I can make you the organizer. Okay. Can you grab the screen from me?
Yeah, are you sharing the poll? Because I don't see it open.
Oh. Oops. Okay, sorry, gang. It looks like we didn't get any votes in because I prematurely shut it off. Here's the next poll in the sequence there, Mike. Okay, sorry, gang. Sorry about that. I'd like to know what things you'd like to know more about next, and then Mike, if you could share the Power Options tools.
I'm not going to be able to go too in depth with them, unfortunately, but we do have an archived presentation we're going to put up from Tuesday, which goes through that. The main tools, the search tools, and the portfolios for analysis. Unfortunately, today I can't, stay longer than probably 5-10 minutes after the 1 o'clock hour here, so we're not going to be able to go too in depth into the tools today.
Okay, all right. We don't have to go super in depth. Can we show the risk graph of a recent client? All we need is XEC. with a $20 cost basis and the September $70 puts at $3.
Okay, let me pull that up right now.
Very
And you
good.
still have your poll open, correct?
Yes, yep, that poll is still running, and I'm going to go ahead and close her up now and share the results. Ladies and gents, sorry about, I got a little wordy today. And sorry about that. I just want to make sure that we explain things real thoroughly, and I didn't give Mike enough time to explain his platform real well. However, it looks like even though we didn't take a real close look at Mike's platform, look, Mike, do you see the results on those polls?
Hold on, sorry. Yes, yes I do. Mm-hmm.
We've got just the largest amount of folks that want something. They want the Power Option Search and Destroy platform.
Mm-hmm.
So we'll have to make sure and give that to you. We're going to give away 2 weeks free of that. No credit card, no obligation. Just try it out, okay? All right, let me go ahead and close that.
Okay, it's my turn now. I just wanted to make sure, and now we should be up and running. There we go.
Groovy.
All right. Okay, so, well, here's the inference card. I think I got this right. You wanted me to show XEC. Well,
Yes.
Before I do that, let me give a brief description, because Bill had some questions coming in. And at the beginning, there were some questions Bill wanted to know about what is the difference between fission and between power options. Well, let's just break that down quickly before we go into this.
Okay.
Kurt's full method is described in the blueprint. Kurt wrote the original blueprint back in 2002. It's been expanded and added to. There's now 10 different income methods. Okay, so the blueprint is Kurt's full description of his radioactive trading methodology. All 10 income methods, what to look for when you're opening stock, for example. The fission subscription on radioactive trading, if you're just following along with the free information or you've recently purchased the blueprint, you can follow over Kurt's shoulder by subscribing to Fish and watch as he makes his trades live in his personal account. It's not really an advisory service, but it's more of an educational process where you can learn more of the income methods in addition to what you've already got in the blueprint, which describes everything, but you can see them being traded in the real markets and Kurt's logic behind why am I doing this adjustment, why am I doing that adjustment. Now, Power Options is a patented suite of search and analysis tools designed for self-directed investors. We support over 23 different option strategies. When we first got together with Kurt about 3 years ago, we enhanced the married put strategy and the portfolio tools to work with Kurt's method in addition to supporting the other different option strategies as well. Now, the tool we're looking at right now is just the custom spread tool. This analyzes a profit and loss chart for us. This has nothing to do with the patented search tools or the portfolio analysis. But what we're viewing here is just a simple setup of buying 100 shares of XCC. It's $20 per share. And later on, I guess as the stock moved up, looking at purchasing the September 70 put for $3. And then we see our profit and loss chart here. Kurt, does that look right to what you wanted?
It sure does, yeah. What we've got there is the familiar hockey stick graph, but with no break-even line, okay? And now what I had hoped to do was to share, this is Tom's stock. I also wanted to share, if we could, Bill's stock, but maybe we'll have to do that next week. And Bill started from scratch, okay? He bought stock and also bought a put at the same time and was able to bulletproof it by repeated use of income method number 4. Now, this gentleman here, whose stock we're looking at now, already owned the stock, and he wanted to be able to bulletproof it and not pay anything. Okay, so let's roll up. He has had to pay something, hasn't he? He's had to pay
$3.
$3, okay? Now, what we can do, let's go ahead and add these options. He did a bear call spread, so he sold the August $80 call and also bought the $85 call.
Okay.
Now, they're not where they were yesterday. Okay?
No.
But what he did was generate a credit of $1.80. Let's just say it was $3 for the $80 call and $85. I'm sorry, $1.20 for the
Okay.
And see what that does to change, Mike. Down there right now where it says maximum risk is negative 4,700.
Right, negative 204.3%. Yep.
Okay, now submit those changes and see what happens. Did it take it?
It's running it, yeah.
Oh, I see. Okay. The maximum risk said 4,700.
Right, for
negative 4,700.
That's always important.
Meaning he's locked in that kind of a gain.
Mm-hmm.
Okay. But now, by purchasing the put, okay, he's got an insurance policy, and by doing the bear call spread, he's paid for a lot of that put option.
Okay.
Boy, it's still taking a while. Huh? It must have something to do with the technology of the screen sharing that we're using, because whenever I'm on pair options, it happens instantly.
Yeah, I'm not sure what's going on there, but it's trying to come up. Let me just see if I can do that real quick. All right. Okay, it's just, there we go. Oh, no, it didn't like that at all. Let me go back.
We're out.
Nope. Let me try this again. Sorry about that, folks. There we go.
Very good. Okay, now look at that maximum risk again. It's negative. It used to be negative 4,700. Now it's negative 4,880. What does that mean, Mike? That means it's a guaranteed 4,880 return, right?
Right.
So by doing that bear call spread, did he entail any risk? Did he give himself any risk?
No, he lowered his risk further, didn't he?
That's right. Okay, and we've got this hiccup in the middle. And you know what that hiccup is all about? That's the fact that we've got a short call and we've got a long call in the context of this radioactive profit machine. So let's scroll up, Mike. You know what he did yesterday was close the short call only, the short call only for 25 cents. So what that would do is that would reduce his cost basis, wouldn't it, on the stock by $1.55. See, he received $1.80 credit.
Right.
Now let's clear, not the long, but clear the short only. And then change the cost basis of the stock by $1.55. So now it'll be $18.45.
Okay.
Okay, and submit again. And look what happens. Mike, he's still got the long call options. So he's in a better place than before. He's still bulletproof. He's still taking dividends. And that curve is starting to look like an exponential curve going up. That's because he's long stock and long calls that he received at a credit. Interesting? Pretty cool. Okay, so that's what I wanted to share, Mike, because I wanted to show what is available, what's possible to you once you have a bulletproof position. You're able to make your upside unlimited, and yet at the same time have no possibility of a loss. Pretty cool? Okay, let's go to radioactivetrading.com, and I know that you've got to go, but I'd like to show folks how to get access to the Power Options tools and also where to go to order the blueprint, because that was, let me see here, 50% of our viewers want that search and destroy platform to find winners, and 45% want to get the blueprints. Okay, so we've got our first and second place winners there. Let's at least take care of that.
Okay.
Okay, what are we looking at?
Well, we're at radioactivetrading.com, and we're in the resources tab, Kurt.
Okay.
And you see up at the top, you can get the 2 free weeks of power options. So if you're not already on a trial or have a subscription, you can get 2 free weeks there. And then the Trade Simulator tool, of course, Kurt, this shows a simulation of various trading techniques if you're using a pattern of a certain risk and reward measure.
Right. With that trial, is it one of those things where you have to supply your credit card information and your address and your mother's maiden name and all that good stuff, or
Nope,
can you just
first name, last name, and email address? That's it.
first and last name, email address? That's it. They can quit at any time. Okay. And so it's 2 free weeks, and then if they decide that they want to invest in Power Options tools like what you were just using to show the before and after, okay, also the screening capabilities to find the winning stocks. Gosh, if they decide to go on, do you give them another 2 free weeks after?
Yes, if you subscribe at the end of your trial, you do receive an additional 2 weeks for free, so you can have use of Power Options for 1 full month before you're going to be billed.
Cool. Okay. And this is the final thing I want to do, Mike, is go over to the blueprint. This is our second place winner. First place winner was the Power Options platform. Second place is my book. How about that? I'm the host, and I come in second. Okay, but honestly, the blueprint will share all 10 of the income methods. Today we've shared 2 of them. And there's 10 different income methods. Also, that CD, Foundations of Radioactive Trading, will kind of add to your knowledge when it comes to trading a full portfolio instead of just trading individual stocks. If you're trading a basket of stocks, it's a real good idea to maybe look at that, Foundations of Radioactive Trading. Now, Mike, that CD has got a money-back guarantee. The book is the bound 250-page book, and it's a hard copy, and we can't do the refund thing on that. However, I don't think we've had anybody try to return it either. So, very good. Okay, gang, that's our dog and pony show. I appreciate everybody for coming. I hope that, like Tom and Bill, you've been able to see some things that could actually even pay for the blueprint just by the free information that we've given you. Like I say, Tom and Bill have actually been able to pay for the blueprint with stuff that they learned before even getting it, and trades that they actually executed. Mike, did you have anything to add, or did any questions come in that we need to handle before we go?
Well, we covered most of them. I mean, there was a discussion we had with Ken. He wanted to know if buying a put after the stock has moved up is the best approach to do in that situation. And I think you showed that with the McDonald's position he asked earlier on. The reason why I, of course, touched upon the description of the difference between Fission and the blueprint on radioactive trading as opposed to Power Options, because Bill had several questions about what's offered in the Power Options tools. We didn't even really get a chance to go into 1/100th there of what they can do for you.
That's right.
So, yeah, and Woody did ask, you did want me to record this presentation. And
yes.
Woody wanted to ask, when is that going to be available? Well, I don't think it's going to be available until possibly tomorrow or tomorrow afternoon, but it's going to be here. You can just go to radioactivetrading.com in the free webinars and podcasts, and hopefully tomorrow you'll see today's presentation up there, and you'll also see Tuesday's presentation up there as well.
Very good. Super. Okay, Mike, thanks for coming, and thanks everybody for your time today, and I'm wishing you the best and happy trading. We'll see you out there.
All right, take care. Bye-bye.